All right, let's dive into Ashford Hospitality Trust, or AHT. Their latest earnings report, well, on paper, it looked like a total disaster. But here's the crazy part. The stock actually went up. Now, that just doesn't add up, right? So today, we're going to unpack that exact paradox.
Yeah, this is the real head-scratcher. I mean, the company reported numbers that, should have sent the stock into a nosedive. So the big question for all of us is, why on earth did investors just shrug it off and start buying? That's exactly what we're here to figure out.
So first, let's get the bad news out of the way. For a REIT like AHT, the number everyone watches is Adjusted Funds from Operations, or AFFO. Well, they reported a loss of $2.85 per share. Now, to give you some context, Wall Street was only expecting a loss of about $1.14. So yeah, that's not just a miss, that's a massive shortfall.
And yet, get this, on the very day all this bad news came out, the stock closed up almost 5%. I mean, come on, that is the paradox we're talking about. A huge earnings miss followed by a stock rally. It's a classic sign that the headline numbers are not telling you the whole story.
Okay, so here's how we're going to break this down. First, we'll look at the earnings paradox itself. Then we'll dig into the Q3 numbers. After that, we'll explore management's turnaround plan, tackle the big balance sheet question, and finally, wrap it all up with our rating for the next call.
All right, let's jump right in. Section 1, Q3 results by the numbers. We're going to take a closer look at those headline misses and really lay out the bear case first. All the data that had people so concerned.
And really, the weakness was pretty much across the board. Revenue? It came in nearly $8 million short of what everyone expected. We already talked about that huge FFO miss, $1.71 per share worse than consensus. And to top it all off, the company posted a GAAP net loss of $69 million. Look, any way you slice it, these numbers are just not good.
This really paints a picture of the pressure on their top line. RevPAR, that's revenue per available room, it's a super important metric for any hotel company. Well, AHT's RevPAR actually declined by 1.5%. Meanwhile, you've got competitors, like Braemar, for instance, that were actually growing. That tells you AHT wasn't just struggling against its own performance, it was losing ground to its peers.
Okay, so that's the bearish view, and it looks pretty bleak, right? So how in the world do we explain that stock jump? Well, the clues are in this next part. We're going to dive into management's turnaround playbook, because that's where the market started to see a little bit of light.
And here it is. This is probably the single most important piece of data from the entire earnings call. You got this headwind, RevPAR down 1.5%. But look at the tailwind. Hotel-level EBITDA was actually up 2%. So how is that even possible? It all comes down to one thing. They got really, really good at controlling their costs and running their hotels super efficiently.
Now, this wasn't just some happy accident. It's all part of a specific strategy they call GRO AHT. It's built on 3 pillars: G&A reduction, revenue maximization, and operational efficiency. The whole point is to add $50 million in run rate EBITDA. And what got the market excited was seeing hard evidence that this plan is actually starting to work.
And here's the proof in the pudding. We're not just talking about a plan on paper. They are executing. Look at this. They sold off 3 hotels for around $75 million to chip away at their debt. They refinanced some key debt, saving millions in interest every year. On the ground, they boosted labor efficiency by over 2.5%. And they kept a really tight lid on spending, only putting out about $5.7 million in capex. These are all real, tangible steps.
Okay, but with all that good operational stuff happening, there is a massive elephant in the room, and that brings us to our next section, the balance sheet question. Honestly, this is the one major risk that's just casting a huge shadow over this whole turnaround story.
And it all boils down to this one number: $2.6 billion. That's the mountain of debt that Ashford Hospitality Trust is carrying on its books. It's a staggering amount, and it puts a ton of pressure on everything they do.
And this chart right here shows you exactly why that debt is so risky. A whopping 95% of it is floating rate debt. What does that mean? It means their interest payments aren't fixed. They go up and down with the market interest rates. So in an environment where rates are high, like right now, well, that's a really, really tough spot to be in.
So what does this mean in real terms? Well, their blended interest rate right now is a painful 8%. Now, of course, management is trying to frame this as a potential upside. They argue that if the Fed starts cutting rates, AHT is going to see a huge benefit. And you know what? They're not wrong. But in the meantime, that 8% is a heavy burden, and it's exactly why they've had to hit pause on the common dividend for 2025 just to hold on to cash.
So where does all this leave us? You've got a company that's actually doing a pretty good job on the operational side, but it's being dragged down by this incredibly risky balance sheet. So for our final section, the next call, we're going to put all these pieces together and give you our official rating.
All right, after looking at everything, we're giving Ashford Hospitality Trust a rating of market perform. This is basically a neutral call. We think the stock is probably going to perform right in line with the overall market. No huge upside, but no huge downside either.
So why the neutral rating? Well, it's because the bull case and the bear case are in a total tug of war right now. On the bull side, you've got the GRO AHT plans showing real results, they're selling hotels to pay down debt, and they're scoring those operational wins. But the bear case is just as strong. The debt level is sky high, their revenue is still weak, and there's always a risk they can't keep executing. For right now, these two stories just cancel each other out.
So, what should you be watching for in the next quarter? We think the stock is probably going to be pretty range-bound, just kind of trading sideways. It'll be super sensitive to any news on interest rates or more asset sales. We're predicting their hotel EBITDA will be flat to maybe slightly up as those cost controls continue to battle weak RevPAR. Really, the key catalyst, the main thing to watch is simple. Can they keep executing on their plan and keep chipping away at that debt?
And of course, we have to end with this important reminder. This analysis is for informational purposes only. This is not financial advice.